Okay, good afternoon, everyone. Welcome to Investing with IBD's podcast. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily, and I am filling in for Justin Nielsen, who is on vacation in Hawaii, allegedly helping his daughter get settled back in. I believe she's a sophomore at University of Hawaii. And so I will be joined by Arusha Pires, as always. He is a portfolio manager at O'Neill Global Advisors. How's it going, Arusha?
I'm doing well, Scott. It's great to have you back on. Justin, take your time. Scott, feel free to stay as long as you want.
Well, so far, I think this is like the third or fourth time I've guest hosted. And so I've done just enough of a good job to be a guest host again, but I cannot seem to supplant Justin. So his job is safe, believe me. So let's definitely obviously jump to the topic of the week, and it's on everybody's mind, and that's the stock market, the increase in volatility, the yen carry trade. There's a million things we could talk about. And so I'm real excited to welcome our guest. Our guest is Mish Schneider. She is the chief market strategist at marketgauge.com, and she will help us to break down all this craziness. Thank you, Mish, for joining us.
Thanks so much for having me.
Right. Thank you. So I guess let's jump right in. The main thing everyone wants to talk about, well, at least I think, is, and I'm biased because I'm a stock market junkie, but let's talk about the stock market. Let's talk about the U.S. market at first, but I'd love to segue, I'm assuming, into what's going on in Japan and your thought process on how that might be affecting our markets.
Well, you're absolutely right that everybody seems to want to talk about the stock market, and I mean everyone. And maybe it's because it's me and people know I'm involved, but from when I'm standing online to the grocery store or getting a manicure or what have you, people are very worried right now because they have been, I think, lulled to sleep in a sense about a lot of things from the media. I blame a lot of the talking heads for telling people, oh, you just keep buying the dip, for telling people we're getting a soft landing, for telling people inflation is over, for telling people the geopolitical situation is nothing to really be concerned about in the US, for telling people our own US election, don't worry about it. And I'm not saying that people should be running around in a panic state, but people need to be somewhat aware, especially depending on their age, because obviously younger people can sit out some of these storms while older people cannot. And in terms of their socioeconomic bracket, because some people have their life's money in the stock market while others have discretionary money. So yeah, it's big. And right now we're seeing a sea change in everything.
And so what is that? What is that sea change? And I guess maybe what really kind of got this, because the market's been running for a while, right? So what really kind of what really got it rolling to the other side and going into a correction?
Well, in order to look at that, we first have to look at how come the market rallied for such a long period of time. And it's a very interesting situation with monetary policy, because I didn't even mention that. And that would be the Federal Reserve and what they've been doing. So we know for the last 22 months, they have stayed the course after this incredibly mind-blowing rapid rise of interest rates, which put the pressure on the market in 2022. And once it was kind of announced, as we went through a little bit more of a tumultuous 2023 and then ending 23 from October on really strong, it wasn't so much about whether or not they would lower the rates. It was more like they weren't going to raise them anymore. And the market was kind of happy because they were starting to see pockets improved and inflation coming down naturally. But we all kind of knew between that and what was happening globally that complacency might come home to roost. So this is what's going on right now. We've had a tremendous amount of corporate buybacks, particularly in the tech stocks, even though there's been headlines all over the place about the CEOs of these companies like NVIDIA and Warren Buffett selling Apple, selling NVIDIA, selling shares of Bank of America in the case of Buffett. But people ignore that because they figure, oh, they're taking profits. So then I think what really changed was two incidences last week. And not that it was a surprise to some of us, but it's definitely been a surprise to a lot of very passive investors. So number one, you mentioned in the very beginning, it was the yen carry trade and what happened in Japan. which the lesson is that you can only manipulate things for so long. And when it's that fragile, then things will definitely shift. So obviously, right, they raised the interest rate, and that just sent everything spiraling. And what's interesting is it was almost perfect timing, because it was the day that Powell spoke as well. And what the market heard was some capitulation as far as how confident he was in the US economy, although he played it down. So if you combine the two things, you had this massive exit that happened last week, and then what started on Monday. But interestingly enough, everything held this very key support, and now people have started to pile back in. I've heard investors from an institutional side haven't even sold yet, whereas retail people have gotten out, obviously because they're more active. So the question is, what breaks now? And should we go back to complacency and just say, oh, market's going to chop around for another few weeks because it's summer? Or are we in for something more insidious?
Yeah, so the word you use that resonates with me is fragile. If I got this right, they raised rates to 0.25%, and it caused havoc, especially in the Japanese stock market. I mean, they went from bull market to bear market in a handful of days, and so skeptically, I'm just like, wow, if a 0.25 point is going to cause that kind of havoc, I would hate to see if they raised to 0.5 and then 0.75, and it's so low. But yet, I guess it's the message of it's not just the number; it's more the trend that is occurring.
Well, and also let's not forget that it took 40 years almost for the Japanese stock market to make new highs. I mean, it peaked in 87 or 88, and it's taken all this time to 2024, and it didn't last very long. So, so there's a couple of lessons right there, clearly, and one is, right, as soon as you actually try to get real, the fantasy goes away, and two is things can stagnate for quite some time, something we haven't seen here in the US. From like in 1966 to 1985, we had a stock market that basically went sideways. And some of us are old enough to remember, but others aren't. So the lesson from Japan is, right, nobody's bigger than the market, not even the government.
Yeah, so eventually it's going to come to roost. It looks like it's starting to right now, and it's affecting our market. So here in the US, especially for our listeners who are, I'm assuming most are investing in U.S. type of stocks, how should they handle this type of volatility?
Well, there's a couple of things, and one of the things that I'm very excited about talking with you guys about today is where they can look to see when the cracks, or if the cracks get wider or not. So we'll get to that. But right now, I mean, basically what I would say is that I'm more in the retail side of things, in that I think that having taken profits in a lot of the tech stocks, they peaked even before the small caps. Of course, the small caps were so underperforming for so long and had that massive run after the semiconductors started to come off. And the sentiment of the market was, oh, great. I mean, now, this is a much healthier market with small caps leading. Right. Instead, the real message was, right, well, tech is kind of broken. This is like a last gasp, and the small caps probably not one to chase onto the highs. So I think you had to really take that as a signal to lighten up. And now, let's talk about buy the dip. I am, again, depending on who you are and what you have, I don't think the dip is over. I think the rally we saw over Monday and Tuesday, once the market corrected on Monday, and then into Tuesday when we had the turnaround, and now today, Wednesday, that started out green and wound up red, is a sign that we're probably going to have another leg lower. So to me, if you follow the signs and you want to start buying, first of all, you need the cash to buy with, right? So that's why we've raised a lot of cash right now. I have my shopping list. So I'm looking at certain equities, of course, to see where they go and where I would be more willing to buy. And people have totally forgotten about commodities again. Oil and energy, kind of natural gas, gold and silver, sort of on the back burner. And yet I still believe with geopolitical situation and the fragility, as we just talked about, we may actually see some kind of a re-escalation of inflation as we get into later in the second half of the year. So that's what I think. You need cash. You need to be protective. You can look at defense stocks and keep your eyes on commodities. You should be holding some gold in your portfolio as just part of it. And then we could talk about what I think you need to watch in order to have your timing better.
Okay. And so you mentioned a few things like having cash. To have cash, people need to sell. Sell has been a 4-letter word for many years in the stock market. So I guess I'd like to pivot just slightly is how do you help people to understand a mindset that it's okay to sell? It's okay to take some off if you have really large gains. Maybe you don't have to sell all of it, but for me, one of the great advantages to being an individual investor running your own money is you don't always have to be 100% invested. And so in times like this, if you're 30 or 40 or 60% invested, you actually gain some outperformance because you're not going down as much as the indexes.
Right. And then there's something else we haven't even mentioned, which is you can take some of money out and put it in fixed income while we still have yields at pretty decent rates, which is very, very safe right now if you're in the right instrument. So that's the other thing is people are afraid of cash because they say, what does cash yield? Well, that was like, so 2020. Right now, cash actually can yield you some good fixed income. So that's a piece of it. But yeah, I mean, I think you need to have the cash and some safety play. And again, I think it's really going to depend on your age and how much money you have, because we know that financial planners, they tell their people, don't get out. You only lose money when you sell. And we're not like that. We're very active, risk managed type of traders, and our clients are well groomed to know that we will not allow a 40 to 60% drawdown in our equities and let people sit there hoping things go up. Let's go back to Japan. I mean, it happened better here, but it didn't happen there. You never know. And number two is, like you said, it's better to have money in the bank in terms of taking your profits. And it's really, really important, I think, and people have learned this since 2020 when we've had the flood of new investors in the market and day traders. And let's not talk about zero DTE traders, but I mean normal, not that they're not normal, but typical, there's the word, typical traders here. So yeah, I think you have to look actively. So let me give you a couple of clues of what I think is really important to watch right now. And believe it or not, I'm still of the mindset, even though I'm a futures trader from way back, I'm still in the mindset that the bond market is going to give us the ultimate clue. I mean, you can watch the dollar because the dollar yen, and we know the dollar broke down under important support. But I think you have to look at two bonds, the long bonds and the junk bonds. That is, to me right now, pretty much all I'm focused on outside of the commodities market. And even though there's a relation. So the long bonds, right, after the 60-40 portfolio that worked for years and years and years, lost a lot of money over the last several years. If that starts to come back into favor, then basically what's that telling you? That the flight to safety back into long bonds is not necessarily a good sign. And that's where you're getting your recession people coming out and saying, oh, we're heading to a recession. The yield curve is starting to uninvert. That's a sign. Money flocked into long bonds. I just actually read that Buffett has a lot of money in long bonds. We have a little bit of money in long bonds. Another one of those things. But if it breaks out in TLT over 100, I think that's going to be a very telling sign. It went right up near there in October 2023 when the market was going down. It skidded, started dropping. As yields started rising, the market felt that was a sign of confidence. And of course, we know that's when all the buying came back. So that's number one. Watch your long bonds. Number two, watch your junk bonds. And we can look at HYG if you want to put that up. Because that's still very much in a risk-on situation right now, which makes this tough, right? This is tough right now. People are confused, and this is a really good reason why. But this will also be the thing to help you from being confused for too long. Number one is the junk bonds right now are still doing okay. Why? Because high yield debt has paid off, obviously in a risk on environment and with high interest rates. Number two is if it continues to go up, I wouldn't get too nervous, and we could start talking soft landing again, which is right now on the table as opposed to recession. Yet, if the junk bonds start to roll over from here and break down under really basically the July lows at this point, which also corresponds with a very key moving average, then I think what that's telling you is that people are abandoning high yield, especially if they're going to go into the long bonds. And this market is definitely somewhat in trouble. How big a trouble will remain to be seen, but maybe some bigger trouble than we're having right now.
Okay, we'll take a short break. Thank you, Mish Schneider, Chief Market Strategist at MarketGauge.com. We'll be right back, and she'll help us determine some of the indicators that she uses to determine macro trends going forward. Stay tuned. Okay, welcome back to the Investing with IBD podcast. I'll be your guest host today. My name is Scott St. Clair with IBD, and I'm joined as always by Arusha Peiris of O'Neill Global Advisors. Our guest this week is Mish Schneider. She is the Chief Market Strategist at MarketGauge.com, and we are going to talk about the Modern Family. So not only is that former big hit TV show, it's a set of economic indicators that she uses to determine where the market is headed. So, Mish, why don't you tell us about your Modern Family?
Well, yes, it was a big hit TV show, but what it really meant to represent was sort of an inclusivity, if you will, of all different types of families. And so I borrowed the name, and I have looked into the copyright, by the way, and it was perfectly okay, just so you know. But I call it the economic Modern Family, so it can be more specific. And it really was born out of, I was a commodities trader for many, many years. So I was really able to wrap my head around what was going on in agriculturals or in metals or in grains or what have you. But I didn't really have a full picture in my mind of how to see the associations of what was happening in the U.S. economy. And this, of course, was even before the real big tech boom, but after, of course, the dot-com bubble. And I started to think about the U.S.-centric sectors. And it dawned on me that small caps, for example, were really kind of the granddaddy of the U.S. economy. And if you look at GDP over the last several years, we haven't really had steady economic growth. We certainly have had periods of decline, obviously COVID being a big part of that. But even coming back, we still are not in that area. And that's why IWM, or the Russell 2000, became my granddad. And then I also realized that the consumer is probably the most important part of the U.S. economy. I mean, not just U.S., most economies, but again, keeping U.S. centric. And so I wanted to really keep it simple, and I came up with XRT because it's a nice blend of consumer discretionary and consumer staples. So it kind of covers you regardless of what the economic condition is. So that's grandma. And then I rounded out the family by what else is really important to see what's going on in the economy, and certainly transportation, borrowing from Charles Dow back in the day. The transportation index, I use IYT, super important, because if you don't know how goods and services are moving in this country, which definitely moves the economy, then you're overlooking an extremely important part. And then, of course, semiconductors, because that's been the prevailing place to be for years and years now. And then I rounded it with regional banks, not big banks, but regional banks, which turned out to be really prescient, particularly last year in March when we had the crash of the commercial bank sector, which really brought down KRE. By the way, SMH is what I use for semis. And then IBB, which is my biotech sector, because I love that. It's both cyclical and non-cyclical in that, depending on what the economic condition is, biotech can do well like, for example, during COVID, which was certainly a non-cyclical time, but can do well cyclically because when money can go into R&D, those drug companies tend to do better. So that's kind of the whole family right there.
So how do you use them? And maybe just walk us through kind of your analysis going through each of the ETFs and what they're kind of telling you and how you kind of bring it all together.
Okay, well, first of all, I was very fortunate to be up at the office in New York with you guys and Mike last year, and we did a little recording, by the way, on the economic modern family. So I don't want to get too repetitive with that, and maybe you guys can figure out where that is so people can listen if they want.
That's homework for Mike right there, too.
But here's what I do. Depending on the market condition, and I wrote a book called Plant Your Money Tree, where I use the economic modern family, but I also use the weekly charts because they're so key. If you can plot all the different areas that I just mentioned, which are 6, into weekly charts using 50 and 200-week moving averages, then you get a sense of the phase and what is rotating, where cash flow is coming in, where things are flowing out of. When they're all in sync, how powerful that can be in terms of telling you how much you should be invested. And when they start to get more divergent, what that tells you as well. It's all great information. So, this is an unbelievable time right now to be looking at the modern family, because if you look back at 2024 from the beginning, you will see that semiconductors was just on the tear, but yet nothing else really participated at all. So you kind of knew that, yeah, have fun in semiconductors, but it wasn't really translating into the US economy because of all the reasons we just said, right? Mm-hmm. If the retail area is not really flying, and the small caps aren't really flying, and the transportation sector isn't really flying, at some point, there's going to be a top in semiconductors, and that's exactly what happened. So how I use the family is, if I want to step back and get a macro, is I look at those weekly charts. So if we go to what's happening right now, we did over the last couple of weeks see the retail sector try to move, but it didn't get very far. We saw the Russells try to move, but it completely reversed last week. Same thing with biotech. But meanwhile, semiconductors did top out, and regional banks tried to make a move after months and months of being basically in a trading range, but transportation did not make the move. And this is where the family becomes so important, because while people were starting to call for 6,000 in the SPY, even with tech going down, saying this was the big buy opportunity, because look at small caps, they're going to lead us to nirvana. I'm looking at transportation going, well, why isn't our good old Tran not participating? After all, we need them to be involved. We need to see robust movement of goods and services. Well, part of it was CrowdStrike. Okay, so that was, definitely more of a watershed moment. But even before that happened, it wasn't participating. So that's when I started getting really cautious. And that's where the economic modern family does really, really well. So here we are in this moment in time, and they're all back on critical life support on their weekly moving averages, whether it's the 50-week in retail, the 200-week in the Russells, the 50-week in semiconductors. The one that has actually broken down and is sitting there desperately trying to hang on for dear life is, guess what? Transportation. So you can look at that and see what happens. If it holds here and everything else held support, along with what I told you with bonds, we should be okay. If that starts to break down, it may be a more than an early warning, more like a sustained warning.
So
go ahead, Scott. Sorry.
Cool. I was just curious about the moving averages, because I think that's something concrete that our listeners can use. So you talked about when you said 50 week, I assume you mean 50 day / 10 week. Is that correct? Or do you use a 50 week?
I use a 50-week simple moving average.
Wow. Okay. Good.
Yeah.
Good to know.
Much
So
more.
I use a really long-term moving average. Mm-hmm. So definitely going to reduce the noise there. So I would not know where we stand on all these ETFs based on like the 50-week moving average. Or half of them below that? What's kind of the metric that we're looking at now?
Well, again, if we go through 2024, except for the regional banks and transportation, they've all been holding their 50-week and even trying to hang out above the 200-week. But the position of the moving averages is also important, because in the retail space and in the small cap space, in a bullish market on a weekly basis, you want to see the 50-week above the 200-week, or what we call a stack. But to date, most of the modern family members have the 200 above the 50, which means they're in accumulation, but they're not bullish yet. That's also more information. So right now, not only did they not really hold, but they're back testing that 200-week, which, remember, is above the 50-week in those three critical areas. But now transportation is breaking down, especially if it breaks down under, let's say, IYT 61 this week. Mm-hmm. That will be the first one to break down under the 200-week. And again, when one of my premier members break down on a weekly basis, yes, it's a bit of a longer view. And I use the daily ones as well, the 50 and the 200 day. But from a longer term view, it's extremely helpful, especially, like I said in the very beginning, which we talked about, is people don't know whether or not we're risk on or risk off right here. Things are that delicate.
Yeah, and it's kind of like what Scott said, where it reduces the noise. You're not going to get too many signals if you're using really long-term moving averages. But Mish, when was the last time? Now, do you need all of them working, or when was the last time enough gauges were headed in the right direction that it was telling you, yeah, this market is healthy?
Well, I have not seen them all working together in quite some time, by the way. They did in 2021. Let's talk about that.
Yeah.
When we were coming out of COVID and the Fed was feeding money to everybody along with the government, then everything was flying. Right. And that was an incredible time to make money. And a lot of people
before that, where
like before 2020,
because obviously, before 2020, I mean, after 2020, it's just been obviously unusual. Okay. But yeah.
Well, let's talk about. All right. So it's always great to look at. Well, usually one will trigger first. So if we go back to 2008, by the way, okay. After we got through all of that in 2009, when we started to bottom.
Yeah.
In 2009, 2010. You really started to see, and I'm saying this off the top of my head. I mean, obviously, I would like to look at the charts from back then and to be more confirming on this. But that's really when I started getting super bullish, because all of the family was starting to move up at that point. Semiconductors were bottoming them out, although they took a little bit longer, interestingly enough. They bottomed out in like 2012. But retail and small caps and the banks and biotech all started bottoming out first and moving together. But really in the last, I don't know, since like 2016, 2017. 2017 was another one, by the way. Everything moved up together in 2017. That was another crazy year to make money. It was like throw a dart at anything and you were going to make money. But since we had that Fed taper tantrum in 2018, right. And then into COVID, and then since COVID and since 2021, we've been very bifurcated, which is why you have to watch the complexion of the market change. This was very much a year where in the beginning of the year, buy anything that was moving. Momentum stocks were in high gear because you had all the retail money piling into it. But for those of us who are watching the family, we're saying, hey, well, take profits on the way up, because it wasn't really a good sign for the economy. It was just more of a sign of herd mentality, people piling in because they thought AI was going to be like save the world from like everything, which it might, but I think it got a little ahead of itself, right?
Right.
Based on what the rest of the family said. So I guess the best thing is I like to tell it as a story. I'm a storyteller. And the story, what we're being told right now is the tech valuation has come off a lot, and we still don't really know if this is kind of the bottom right here and the great buy opportunity, or whether we're going to see another leg lower and find valuations at much cheaper, because AI costs are starting to go up, by the way. And that's not something you're hearing very much about in the media. The story we're also being told is right. The transportation system, whether you want to blame CrowdStrike or whatever, the consumer in terms of its buying is getting stretched. We know about credit card debt, but the retail sector could also be a very, very telling sign about what's happening in the economy right now. The cracks from the higher for longer and the higher interest rates that people have had to pay on credit cards. In that story, what we're seeing is that could relate to tech. Are people going to continue to go buy new equipment to keep up with the growth in tech, or are they going to get tapped out? So my story right here is the small caps, the economy, everything right now is telling me don't get too excited. And the Fed might have waited too long, but if they reduce the rates now, the family is going to say, whoa, 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 Chicken Little. Does that mean now they're really, really worried? And that's kind of where the story that I'm seeing the family tell right now. But they're a little bit still somewhat optimistic in that they're hanging on for dear life in hopes that this all just sort of goes away. We don't go into major war, Iran and Israel. That's a whole other thing. Or the yen carry trade doesn't necessarily go through another leg down and bring us down because we're so tied in. And also, let's not forget even just the supply chain and weather issues that we're having across the world right now as well.
So would you use these signals to trade these ETFs, or would you use these signals as an overlay that, okay, the SMH is giving me a bullish signal and I'm just throwing this out there as an example. Therefore, I want to find the leadership in the semiconductor group. And lo and behold, there's NVIDIA, that's leadership. That would be the stock I would buy. I'm curious about the execution of this ideas of this tool that you have.
That is such a great question, Scott, because the answer is both, right? I will, and one of the things, my fantasy is that we get, Market Gauge has created a lot of quant models using TSI, and we're working on one for the economic modern family, which would probably start out as a long only type situation. So to answer, I am kind of the quant model right now in my brain. And yes, I will buy, and I will even recommend in my writing or on Twitter or some of the media I go on, which part of the economic modern family is getting ready to move based on a breakout, whether it be on a daily chart or on a weekly chart. I can use monthly too, but we can talk about that another time. So like, for example, right, when semiconductors were starting to make the move, just like you said, NVIDIA, when really things started moving in November and December 2023, and then continued in 2024, that was the only really great place to put your money. And so that would have been a trade, which we did make. And I would have kept my eye on the rest of the family to see if it sputtered. And there was a couple of times where it did, mainly after it got started, but the small cap sputtered in April along with retail. That gave us a little bit of a fear. We got out of some of that semiconductor stuff and then got back in. So there's two ways to use it. One is, right, to follow the trend. And the phases are extremely powerful. These weekly moving averages work great if you're a longer term trader. And on a daily basis, they work great if you're more of a mini swing trader. But if you're really baffled by the bifurcation of the family, then you're now using it more of information and you're sitting mainly in cash until you see a clearer path.
Okay, great. So thank you, Mish Schneider, Chief Market Strategist at MarketGauge.com. We will take a quick break. And then when we're back, we will have her give us some more specific trade ideas that you guys can add to your watch list. Okay, we're back with the Investing with IBD podcast. My name is Scott St. Clair. I am joined by Irusha Pires of O'Neill Global Advisors. Next week's guest happens to be of O'Neill Global Advisors as well. Fan favorite, Charles Harris, a portfolio manager at O'Neill Global, will be joining the show. And we're presuming that Justin will find his way back from Hawaii, although you never know.
I wouldn't blame him. I wouldn't blame him.
Yeah,
one time.
I know every time I've been there, I've thought, let's just stay there, although it's expensive. So anyways, joining us this week is Mish Schneider. She is the Chief Market Strategist at MarketGauge.com. So we've just talked about her economic modern family. And what we'd like to talk about now are some potential trends that she sees for 2025. Thank you, Mish, for joining us.
Thank you. Well, I think we need to, since we're only just slightly over 2024, we still have a good chunk of time left. I want to talk a little bit about the fact that something we mentioned much earlier, which is the complacency in terms of inflation, because there is definitely a divide between what the CPI is saying. And if you go out shopping, like you just mentioned, Hawaii is expensive. That is for darn sure. but having been there, but everywhere is still extremely expensive when you're talking about the two things that people need the most, which of course is food and energy, or oil and gas. And so I think as we're going into the end of this year, with the commodity index having gone down so much, I think it's presenting as a very low risk opportunity right now. So we can, and because that's going to tie into where we're going to go, by the way, for 2025. So it's not a random thought. It's me trying to be very succinct in my explanation.
You're trying to create a new family here, I think, Mish, right?
Yeah. So yeah, we're leaving the family here for a second because commodities, we call them cousins and relatives. And in fact, utilities, in my book, I say if Uncle Ute shows up at the door drunk, it's time to pay attention. And certainly utilities have been acting very, very well. Even in a high interest rate environment. So, and that's because of AI and data centers. We'll get back to that. I don't want to lose my train of thought. So right now we're in a very interesting situation for the commodities market. Number one is from a seasonal standpoint, we have some issues that can create havoc from a Mother Nature standpoint, right? We're getting frost in Brazil. Coffee futures went crazy today. We have a geopolitical situation, as we just mentioned, particularly in the Middle East. So we're starting to see movement now back in oil when people were sort of forgetting about oil. Oil over $75 a barrel has led to rallies. So that's something to look at. And natural gas, the good old widowmaker, has come way down, but looks like it's trying for some fundamental reasons, but even from technical reasons, to bottom here. And if it gets over like 220, if you're looking at the September contract, you might want to look at an ETF like UNG. But the other thing about commodities, of course, is gold, because gold has been both an inflation hedge and a safety play. And even though gold has been fluctuating, it started out this year at 2,000 and it's still trading over 2,400. I mean, people think, oh, gold's over. I don't see that at all. So that's another one that I would talk about. The other thing to talk about, of course, when it comes to commodities is that we have to look at the strain on the raw materials of AI and all of these increasing data centers. And one of the reasons why we may see more correction in the tech sector is because their costs have gone up. But part of the reason why their costs have gone up is because the cost of raw materials. So what do they use? They use silver, they use natural gas, they use water, they use aluminum and tin. So these are all the type of commodities that have been very volatile already this year. But that could be something that might really, really go up and I think catch a lot of people off guard if they do, particularly if the dollar goes down and the long bonds, as we mentioned before, start to actually go up, because it also helps commodities, obviously, when interest rates are lower. Okay, so that's the first thing. So where does that all lead us now? And so my thing for 2025, oh, and by the way, we could throw Bitcoin in there too, because after the halving, it's been chopping around. But if that can start to move up in September, October, that could be another opportunity. It's been doing exactly what it does every halving. It goes down first and then it starts to go back up like in September, October. So something else to watch, just as an aside, because we can call that a commodity in essence. Anyway, if this happens, the stress on oil and gas, and particularly if oil does actually really surprise and make a nice jump up here, One thing that I think I started out this year saying was that EVs were going to be completely out of favor in 2024. And so far, that is certainly proving to be true. We just had this big run in Tesla, but now it's all the way back down again. But Tesla's more than just a car company. So we're looking at things like Rivian in particular, obviously Ford and General Motors. These electric cars, I believe, will make a comeback in 2025, along with alt energy, as more and more awareness, regardless, and I hate talking about this because it sounds political, but I do not mean to be political. I'm just saying from a logical standpoint, when people collectively start to realize that the strain on raw materials, particularly oil and gas, and the infrastructure and all of that, and the fact that now we're seeing the utilities go up because of electricity usage going up. Oh, copper's another one that's in there in terms of demand. Once people realize that that is something that is expensive, they're going to go back to wondering, maybe we should be looking at solar energy. Maybe we should look at wind energy. Maybe we should be looking at these EVs again, because they've been forced to come down so much in price. So Rivian's probably one of the top stocks. It just reported. It didn't report well, but we didn't expect that. But we're looking to see if it can continue to base out here between, say, $13 and $15 a share. And that might be something you can start a position. So that's how all the commodities fit in with the EVs and a trend that I see coming, including alt energy. I mean, if you look at TAN, that's been beat to a pulp. All of that, I think, could change as we go into next year.
One thing that you said that I'm very interested in is the data centers. So I'd like to go down that road a little bit more, because that, to me, if AI is real, and I always, use this phrase a bit tongue in cheek, I know it's real, but if it's really going to be a game changer, then the energy that it's going to take to power all these data centers is going to be immense. So I'm just curious about your thought process there, and how would you play it? Like we've got, the utilities like CEG comes to mind, or VST, or would you just use like just a simple ETF like the was it XLU? Is that the ETF?
Well, XLU is utilities. Yeah.
So would they be one and the same, or not really? Sort of, but not exactly the same, right?
Right. Well, you obviously, when you're looking at ETFs, you have to look at other things besides what their holdings are. A lot of them have exposure to treasuries. A lot of them have exposure to the dollar. So I've learned that ETFs aren't quite as simple as one would think, particularly when you're talking about commodities. But if you're not going to become a futures trader, which I'd say most people probably won't, although there are a lot of people out there that are starting to discover them again, then yeah, you can use these ETFs very well. And so, if we're talking about, like I said, alt energy, I like to look at PBW. That's one ETF. I like to look at TAN, TAN. That has made some incredible moves through the years. When it gets going and it starts to really increase in volume and open interest, it's a wonderful one to follow. If we're looking at the data centers in and of themselves, you want it, copper is very interesting, right? Because copper in a recession goes down, but yet there's a limited amount, and it's a huge raw material for increasing AI in data centers. So that would be COPX is one of my favorite areas to look there. So coal would be another one. So again, if you wanted to trade coal, you could actually look at COAL, which is an ETF. So I think you have to do your little research and see which ones appeal. Some of them have tax implications on your K1s, while others don't. That's another factor. So yeah, but going back to the data centers in the AI, what's interesting is, right, everybody thinks that AI will just continue to go up. But like I said, we're already starting to see the sputter because of the costs. And so it could be that we'll start to see that cycle flip, where the costs of the raw materials get more expensive, which means more inflationary for those, while the tech prices have to come down until such a point which always happens with commodities, is eventually they get controlled either through margin calls or through higher interest rates or through more production. And when you're talking about the production of these sort of things, it's not like you can just jump in a mine and voila, in 2 days have more copper. It takes time, but eventually the cycle ends. So that's kind of, does that answer your question, Scott?
Yes. Yeah.
Okay.
So Mish, let's talk about the second trend that could potentially do well, the vanity trade. Walk us through that and where some areas or why you think that this trend could go into 2025 and have some success.
Well, again, my being a little bit of a storyteller, I was saying that up until these diet drugs started to really become more mainstream, the collective consciousness of the consumer was all about we. I'm going to take my family and travel. I'm going to go into restaurants. I'm going to, do all these fun things as a we. And the diet drugs and the economy are starting to shift that into all about me, which is why I'm calling it not me, but me. That's why I'm calling it the vanity trade. Because I do believe, first of all, if we look at some of the stats here, 38% just in the United States of people are considered obese. And it's been very difficult, as we know, for people to have any kind of sustained weight loss with all the fad diets that have come out through the years, whether it's keto, this, that, or the other thing. I've watched many, many close friends and family battle with this, and now they're taking a shot of Ozempic and they're starting to lose weight. So I started to think about this. And by the way, I'm not the only one. I mean, this is not just my idea. I've heard other people talk about this as well. But think about it, even if you had half, so let's say 15% of the people who were classically obese find success with the diet drugs. And we know Novo Nordisk is doing it, Eli Lilly is doing it, even Pfizer's trying now. There are a couple of other companies. I see commercials now all the time for GLP-1. They have to become a little bit more affordable. But if they do, and we have a whole slew of people entering as consumers from a different mindset, like, okay, well, I've just lost 70 pounds and I can obviously keep it off. What does that mean in terms of what they're going to do for themselves from there? They're going to feel good. And that could mean, well, if you've been obese and now you lose a lot of weight, you might need a little tightening, right? So I've been looking at companies like AbbVie, which, by the way, is doing incredibly well. It's trading at $187 a share. That's a company that can continue to do well because of the vanity trade. Or people could be looking more at just general skin care. So I've been watching like ELF, which has come off, but ELF is something to keep an eye on as we get into this trend. Coty would be another one. New Skin would be another one. It requires a little bit of research, but that's skin. Now let's go to physicality. So now all of a sudden, maybe these people are going to be buying more from places like Lululemon or other athletic areas, Nike. Maybe they start going to the gym. Maybe fast food restaurants don't do as well because they start wanting to eat healthier. So I think you have to look at it as a shift for so many people that could really help certain areas of the market.
I love it. It's one thing I love about investing and is I'm not very good at this, but I do love you just observing the world and seeing how everything is intertwined and it connects, and how like fast food would be affected by if lots of people were taking these drugs and their appetite suppressants, not going to eat as much. So it's just being observant and how it all plays out in the stock market is it's one of my favorite things about it. Arusha, anything else that you wanted to ask?
What about like, I guess another one that could come off the offshoot of from vanity is dating, right? Where some of those stocks could maybe start doing well again.
That's such a good question because I've been watching Bumble get killed.
Yeah, exactly. Maybe not Bumble.
And I'm wondering at what point, but I think you're right. I think it's something, again, let's just quantify that by saying, right now when the market is nervous and could be going through a downturn and we don't know if we're going to stagflation or recession, what's going to happen geopolitically and all of that stuff, I wouldn't like jump in. But once the dust settle, these are going to be great places, including potentially Match.com and Bumble, because these are the same people who stay home and don't go out and are going to be like, hey, let me show off my new self. And that's the only way that we kind of do things now. I shouldn't say the only way, but the main way is through online dating services. So I would keep my eye there too. I mean, at some point, unless you think these companies are going to go completely out of business and nobody's ever going to go out again, they could actually come back into vogue.
Great. Awesome. All right. Thank you, Mish. I wanted to give you a chance for you to give our listeners a way that they can follow you, reach out to you, or on, I always want to say Twitter. I know it's now X, but any feedback you have for ways for people to reach out and follow you?
Absolutely. Well, so first of all, if you want to order my book, we actually, if you do it through our site, it's www.marketgauge.com/book. That's pretty easy, right? And the reason why I say do it there as opposed to Amazon is because we're actually giving away as a bonus a sort of a good course on everything we just talked about in terms of phases and weekly moving averages and daily moving averages. So that's one way just to get exposure to how I've thought and a little bit about the Modern Family. Otherwise, I write a daily. And so if you go to marketgauge.com and you'll see the banner that comes up is to sign up for the daily. I try to make that really actionable and interesting in kind of like an everyday talk voice instead of getting overly technical. And yes, I am X, at Market Minute is my handle. Very active community there. I answer everybody.
Wow.
I really do. I spend a lot of time because I'm so, I've been doing this for so long. I feel like, one never knows how long one is going to be around. And as many people in my community I can help. It's sort of the community I had when I worked on the floor for 14 years and traded there. So at Market Minute, if you want to talk to me there, or you can send me an email, mish@marketgauge. That's another more direct way to speak to me.
Great. Well, thank you, Mish. Thank you for joining us. We really appreciate it. And thank you, Irusha Burris. He's a portfolio manager at O'Neill Global Advisors. And next week, as a reminder, we have one of his colleagues, Charles Harris. He's our favorite portfolio manager at O'Neill Global Advisors. He's definitely a fan favorite. Irusha's a fan favorite, but not like Charles.
No, not even close. Yeah.
Yes, and even Irusha knows that's true. So once again, my name is Scott St. Clair, filling in for Justin Nielsen. I'm presuming Justin will be back. Thank you guys for joining the Investing with IBD podcast. Have a nice night.